Welcome back to our channel, where we will be diving deep into the terminologies that are essential to help you get ready for your financial certification exams like investment funds and Canadian securities. Whether you're gearing up to tackle your exams head-on or just looking to boost your financial vocabulary, you're in the right place. Don't forget to hit that subscribe button and ring the notification bell, so you never miss an update from us. As always, remember to like, comment, and share your thoughts. Now, let's begin. Back-end load. A back-end load, also known as a deferred sales charge or exit fee, is a sales charge that is imposed when an investor redeems or sells shares of a mutual fund. Unlike a front-end load that is collected when shares are purchased, a back-end load is deducted when the investor sells their mutual fund shares. This fee is intended to compensate the mutual fund company or financial advisor for their services and management of the fund. The amount of the back-end load typically decreases over time as the investor holds the shares, encouraging longer-term investment. Balanced budget. A balanced budget refers to a financial scenario where the total revenue or income matches the total spending or expenses. In this situation, the inflow of funds is equivalent to the outflow, resulting in a state of equilibrium where the budget is in balance. This concept applies to various contexts, from personal finances to government budgets, indicating that there is no deficit, meaning spending more than earning, or surplus, meaning earning more than spending. Balanced fund. A balanced fund is an investment fund that aims to achieve a balanced combination of income and capital growth by investing in both stocks and bonds, as well as potentially other asset classes. This type of fund seeks to provide investors with a diversified portfolio that includes both higher risk, higher reward equity investments and lower risk, income-generating fixed income securities. The goal is to mitigate risk while aiming for a moderate level of returns. Balanced funds are designed for investors seeking a middle ground between the potentially higher returns of stocks and the stability of bonds, making them suitable for those with moderate risk tolerance and a desire for a balanced investment approach. Balance of payments. The balance of payments refers to the record of a country's economic transactions and interactions with the rest of the world. It encompasses all financial dealings involving imports, exports, investments, and transfers between a nation and other countries. The balance of payments is divided into two main accounts, the current account and the capital account. Bank of Canada. The Bank of Canada is Canada's central bank, responsible for various critical functions within the country's financial and economic systems. One of its key roles is influencing the economy through the manipulation of short-term interest rates. The Bank of Canada uses its control over the overnight lending rate, also known as the policy rate or target rate, to affect the borrowing costs of financial institutions. By raising or lowering this rate, the Bank of Canada can encourage or discourage borrowing and spending, thereby influencing economic growth and inflation. Raising the interest rate can help curb inflation and slow down economic growth, while lowering it can stimulate economic activity. This process of adjusting interest rates to manage the economy is a crucial tool in the Bank of Canada's arsenal, aimed at maintaining stable prices, promoting economic growth, and supporting financial stability. Bank rate. The bank rate refers to the lowest interest rate at which the Bank of Canada provides short-term loans or advances to chartered banks, other participants of Payments Canada, and investment dealers involved in the money market. This rate serves as a benchmark that influences the general level of interest rates within the financial system. When the Bank of Canada raises the bank rate, it becomes more expensive for banks and other financial institutions to borrow from the central bank. This increase typically ripples through the broader economy, leading to higher borrowing costs for consumers and businesses. Conversely, a decrease in the bank rate tends to lower borrowing costs and stimulate economic activity. The bank rate is a tool used by the central bank to manage the economy by influencing borrowing and lending behavior among financial institutions. Banker's acceptance. A commercial draft, i.e., a written instruction to make payment, drawn by a borrower for payment on a specified date. A BA is guaranteed at maturity by the borrower's bank. As with T-bills, BAs are sold at a discount and mature at their face value, with the difference representing the return to the investor. BAs may be sold before maturity at prevailing market rates, generally offering a higher yield than Canada T-bills. Banking group. A banking group refers to a consortium of investment firms that collectively take on financial responsibility for underwriting a specific financial offering. Each individual investment firm within the group commits to assuming a portion of the underwriting risk. This collaborative approach allows for the distribution of the financial commitment, mitigating the risk for any single firm. Banking groups often work together to underwrite various financial instruments, such as stocks, bonds, or other securities, ensuring that the underwriting process is well supported by multiple entities sharing the responsibility. Beneficiary. A beneficiary refers to the person or individuals who have been selected to receive the death benefit from a financial or insurance arrangement, such as a life insurance policy or a retirement account. Beneficiaries are named by the policyholder or account holder and can be categorized as either revocable or irrevocable. In this case, the beneficiary designation cannot be altered without the explicit consent of the beneficiary. This offers greater assurance to the beneficiary that they will receive the designated death benefit, as the policyholder or account holder cannot change the designation without their approval. Beneficiaries play a crucial role in ensuring that the intended individuals receive the financial benefits specified in the arrangement upon the policyholders or account holders passing. Best efforts underwriting. Best efforts underwriting refers to the efforts made by an investment dealer, also called as an underwriter, to sell a batch of securities to the best of their capabilities. However, unlike other forms of underwriting, the investment dealer does not promise or guarantee to sell all or specific portion of the securities. The dealer isn't obligated to fulfill the entire order or ensure the sale of all the securities. In this type of underwriting, the investment dealer acts as an agent for the issuer, working to distribute the securities to potential buyers. While they strive to sell as many securities as possible, the outcome is uncertain, and the dealer isn't legally bound to ensure the sale of a particular amount. Best efforts underwriting carries less risk for the underwriter but provides less certainty for the issuer compared to other underwriting methods. Beta. A measure of the sensitivity, such as volatility, of a stock or a mutual fund to movements in the overall stock market. The beta for the market is considered to be 1. A fund that mirrors the market, such as an index fund, would also have a beta of 1. Funds or stocks with a beta greater than 1 are more volatile than the market and are therefore riskier. A beta less than 1 is not as volatile and can be expected to rise and fall by less than the overall market. Bid-ask spread. The bid-ask spread is the difference between the current highest price a buyer is willing to pay and the lowest price a seller is asking for a particular asset. To calculate the bid-ask spread, subtract the bid price from the ask price. This spread helps to show the potential cost or profit associated with immediately buying and selling an asset in the market. Bid price. The bid price refers to the highest price at which a buyer is ready to purchase a particular financial instrument, like a stock or bond. It represents the maximum amount that a buyer is willing to pay to acquire the asset. This bid price is contrasted with the ask price, which is the lowest price a seller is willing to accept for the same instrument. The difference between the bid price and ask price is known as the bid-ask spread, and it reflects the gap between buyers' and sellers' expectations in the market. Blue chip. A blue chip stock refers to a widely recognized, reputable, and established common stock of a well-established company. These stocks are typically considered to have a solid track record of consistent dividend payments and exhibit strong qualities that make them attractive for long-term investment. The term blue chip implies that the company is considered a reliable and reputable investment choice due to its stability, profitability, and overall strong financial performance. These stocks are often associated with large, well-established companies that have a history of weathering economic downturns and maintaining their value over time. Thank you for joining us on this enlightening journey through essential financial terminologies. We hope you've gained invaluable insights that will serve you well on your path to success. If you found this content beneficial, don't forget to give it a thumbs up and share it with your fellow learners. Until next time, keep learning, keep growing, and keep reaching for your goals. Wishing you all the success in your financial endeavors.